Welcome, financial thrill seekers, to another heart-pounding episode of Market Mayhem. Today, we're diving headfirst into the wild world of Japanese stocks, where the Nikkei 225 just took a nosedive that would make even the most daring skydiver jealous. Picture this. It's a quiet Monday morning in Tokyo. The sun rises over the gleaming skyscrapers, salarymen shuffle into their offices, and then, bam! The stock market decides to throw the mother of all tantrums. The Nikkei 225, Japan's benchmark index, plummets faster than a sumo wrestler on a seesaw, shedding a whopping 6.7% in early trading. Now, I know what you're thinking. Oh, come on, it's just numbers on a screen, right? Wrong! We're talking about 2,400 points vanishing into thin air faster than you can say sushi. This isn't just a bad day at the office. It's the second largest point drop since the infamous Black Monday crash of 1987. That's right, folks. We're witnessing history in the making. The kind of history that makes economists break out in a cold sweat and traders reach for the antacids. But why, you ask? Why has the land of the rising sun suddenly become the land of the plummeting stocks? Well, buckle up, because we're about to take a roller coaster ride through the twisted world of global finance. First stop on our tour of economic chaos, the Bank of Japan. These financial wizards decided to pull a rabbit out of their hat by hiking interest rates. Sounds boring, right? Wrong again! This move was about as expected as finding wasabi in your ice cream. It sent shockwaves through the market, leaving investors scrambling like tourists trying to figure out a Tokyo subway map. But wait, there's more! Just when you thought it was safe to check your portfolio, along comes Uncle Sam with some not-so-stellar economic data. That's right, the good old US of A sneezed, and Japan caught a full-blown financial flu. It's like a game of economic dominoes, except instead of little dotted tiles, we're dealing with billions of yen. And let's not forget the elephant in the room, or should I say, the bear in the market. We're talking full-on bear market territory here, folks. The Nikkei has tumbled almost 12% over 3 days, reaching a total decline of 21% from its recent peak. It's like watching a financial version of Godzilla vs. Kong, except in this movie, everyone loses. Now I know what you're thinking. Is it time to panic? Well, let me tell you a little secret. In the world of finance, panic is like wasabi. A little bit adds spice, but too much and you'll be crying your eyes out. So instead of running for the hills, let's take a deep breath and consider what this market meltdown really means. First off, it's a stark reminder that what goes up must come down. The Nikkei had been riding high, reaching all-time peaks earlier this year. But as any seasoned roller coaster enthusiast knows, the higher you climb, the more stomach-churning the drop. This crash isn't just a correction, it's the market's way of saying, hey, maybe we got a little carried away with all that optimism. Secondly, it shows us just how interconnected our global economy really is. A hiccup in the US, a sneeze in Europe, and suddenly Japan's catching a cold. It's like a giant game of financial Jenga. Pull out the wrong block, and the whole tower comes tumbling down. But here's the kicker, folks. While the talking heads on TV might be predicting doom and gloom, history tells us a different story. Markets have crashed before, and they'll crash again. But you know what? They always bounce back. Always. It might take weeks, months, or even years, but the trend line of the stock market has always pointed upward in the long run. So, what's the takeaway from all this market madness? Well, for one, it's a reminder that investing isn't for the faint of heart. If you can't stand the heat, stay out of the kitchen, or in this case, the trading floor. But for those brave souls who can stomach the ups and downs, remember this: volatility creates opportunity. While some investors are running for the exits, the savvy ones are licking their chops. After all, when stocks go on sale, it's time to go shopping. Just remember the golden rule of investing: buy low, sell high. And right now, folks, things are looking pretty low. But let's not get ahead of ourselves. This story is far from over. As we speak, traders are huddled over their screens, analysts are crunching numbers, and somewhere in Tokyo, a group of central bankers are probably wishing they'd stuck to their day jobs. The Bank of Japan's decision to raise interest rates is like throwing a curveball in a game of financial baseball. Nobody saw it coming, and now everyone's scrambling to adjust their stance. Let's break it down, shall we? After years of keeping interest rates lower than a limbo champion at a beach party, the BOJ decided to spice things up. They hiked the short-term interest rate to 0.25%, ending an era of ultra-loose monetary policy that had become as much a part of Japan as sushi and karaoke. Now, you might be thinking, so what? It's just 0.25%. But in the world of finance, that's like adding a drop of soy sauce to your miso soup. It changes everything. This move is the equivalent of your conservative uncle suddenly getting a tattoo and a motorcycle. It's unexpected, it's bold, and it's got everyone talking. The immediate consequence? The yen started flexing its muscles. It's been pumping iron against the dollar, appreciating faster than you can say currency exchange. For Japanese exporters, this is about as welcome as a sumo wrestler in a china shop. Their profits, which looked so rosy when converted from weak foreign currencies to a strong yen, are now shrinking faster than a wool sweater in a hot wash. Imagine you're a big shot at Toyota or Sony. You've been riding high on the weak yen, watching your overseas profits balloon when converted back to yen. Life is good. Then suddenly, the BOJ drops this bombshell and your profit margins start looking thinner than a slice of sashimi. It's enough to make even the most stoic CEO reach for the sake bottle. But here's where it gets really interesting. The BOJ didn't just stop at raising rates. Oh no, they went full Marie Kondo on their monetary policy. They announced plans to halve their bond purchases, essentially telling the market, thanks for the memories, but we're decluttering our balance sheet. They're even planning to stop buying exchange-traded funds and real estate investment trusts. It's like watching your shopaholic friend suddenly embrace minimalism. Shocking, but oddly refreshing. Now you might be wondering, why now? Why rock the boat when the global economy is already choppy? Well, it seems the BOJ has been peeking at the inflation numbers and decided it's time to take action. They've spotted widespread wage increases across regions and industries, which in economist speak is like seeing the first flowers of spring, a sign that maybe, just maybe, the economic winter is ending. But here's the kicker. This move isn't just about Japan. In the interconnected world of global finance, when Japan sneezes, the rest of the world reaches for a tissue. Japanese investors are the largest foreign holders of U.S. treasuries. That's right, they've got their fingers in Uncle Sam's piggy bank. This rate hike could lead to a repatriation of funds, potentially affecting U.S. treasury yields and global interest rates. It's like watching a game of financial dominoes, where a small push in Tokyo could topple markets from New York to London. And speaking of dominoes, let's talk about the R word that's on everyone's mind. Recession. Now, I know recession is about as popular as a vegetarian at a barbecue, but we can't ignore the elephant in the room. Japan's economy has been doing the cha-cha slide. 1 step forward, 2 steps back. GDP has shrunk in 2 of the past 3 quarters, which, in economist speak, is like saying, Houston, we have a problem. But here's where it gets really interesting. Japan isn't just any economy. It's the world's 3rd largest. When Japan sneezes, the rest of the world doesn't just catch a cold, it gets a full-blown financial flu. We're talking about a country that's got its fingers in more international pies than a global bakery. Think about it. Japanese companies are major players in everything from cars to electronics. They've got investments spread across the globe, like butter on hot toast. So when their stock market does a belly flop, it sends ripples, no, make that tsunamis, across the financial world. And let's not forget about the yen. This isn't just any currency, it's a safe haven in times of trouble. When things get dicey, investors flock to the yen like seagulls to a dropped ice cream cone. But with the BOJ's surprise move, the yen's been bouncing around like a ping-pong ball in a wind tunnel. It's enough to give even the most seasoned Forex trader a case of whiplash. Now, I can hear some of you saying, but wait, isn't a stronger yen good news? Well, yes and no. It's like finding out your favorite all-you-can-eat sushi restaurant now has a dress code. Sure, it might class up the joint, but it also means you can't show up in your comfy pants anymore. For Japanese exporters, a stronger yen is about as welcome as a sumo wrestler in a phone booth. It makes their products more expensive overseas, which could lead to a drop in sales. And when sales drop, what happens? That's right, layoffs, cutbacks, and a whole lot of economic gloom and doom. But here's the real kicker. Japan's economic woes could be the canary in the coal mine for the global economy. If a powerhouse like Japan starts to stumble, it could set off a chain reaction that makes the 2008 financial crisis look like a walk in the park. Imagine this. Japan's economy tanks, leading to reduced demand for goods and services from other countries. Suddenly, China's factories are producing less, American tech companies are seeing their sales plummet, and European luxury brands are watching their profits evaporate faster than a puddle in the Sahara. Before you know it, we're all caught in a downward spiral of reduced spending, increased unemployment, and economic uncertainty. It's like a global game of economic Jenga, where pulling out the Japan block could cause the whole tower to come crashing down. But fear not, dear viewers. In times like these, we turn to the sages of the financial world for guidance. And boy, do they have some pearls of wisdom to share. Let's take a peek into the crystal ball of economic forecasting, shall we? First up, we have Rob Carnell, head of Asia Pacific Research at ING, who says, "The BOJ has taken a bit of a punt today on the expectation that the very substantial wage increases in a great number of firms is actually going to deliver household spending growth. At the moment, they don't know that." Ah, yes, the classic fingers crossed approach to monetary policy. It's like betting your life savings on a horse because it looked at you funny. Bold move, BOJ, bold move. But wait, there's more. Stephen Major, HSBC's global head of fixed income research, chimes in with this gem. Whether the Bank of Japan decides to hike rates a smidgen is not what matters at the March or April meetings. It will be the totality of the announced policy shift that we will focus on, along with what it does to expectations for more of the same. Translation, it's not the size of the rate hike that matters, it's how you use it. Major's got his eye on the big picture, folks. He's playing 4D chess while the rest of us are still trying to figure out how the knight moves. And just when you thought it couldn't get any more exciting, Major drops this bombshell. Something big in Japan is about to happen. Well, thank you, Captain Obvious. I think we all noticed when the stock market decided to do its best impression of a bungee jump without the cord. But let's not forget our friend Taro Kimura, economist at Bloomberg Economics, who offers this insightful nugget. The unexpected rate hike by the Bank of Japan, which aligned with our predictions, implies that Governor Kazuo Ueda is prioritizing robust inflation metrics over indications of weak demand in the economy, and is moving forward with policy normalization. In other words, the BOJ is like that friend who decides to go on a diet right before a food festival. Sure, it might be the responsible thing to do, but the timing is questionable at best. And finally, we have the man of the hour himself, BOJ Governor Kazuo Ueda. When asked if the BOJ could lift rates beyond 0.5%, he coolly replied, "If you're asking if we view that as a wall, we don't really have that sense." Well, isn't that reassuring? It's like a tightrope walker saying, "Height? What height? I don't see any ground down there." Ueda's got nerves of steel, folks, or maybe he's just really good at poker. Either way, it's clear that the BOJ is playing a high-stakes game with the Japanese economy, and we're all along for the ride. But let's zoom out for a moment and look at the bigger picture. While Japan's financial firefighters are busy trying to douse the flames of market panic, the rest of the world isn't just sitting back and watching. Oh no, they're getting ready to join the party. Picture this. A bunch of central bankers from around the globe huddled around a giant game board playing the world's most intense game of monetary policy whack-a-mole. Every time they smack down one economic problem, another pops up somewhere else. It's like trying to plug a leaky boat with your fingers. As soon as you've got one hole covered, another one springs open. Now, word on the street is that the Japanese government might be considering a large-scale economic stimulus package. It's like they're reaching for the economic defibrillator, ready to shock some life back into the market. But here's the catch. Japan's debt levels are already higher than a cat on a hot tin roof. We're talking about a debt-to-GDP ratio that would make even the most spend-happy politician blush. So, they're stuck between a rock and a hard place. On one hand, they need to stimulate the economy to avoid a recession. On the other hand, piling on more debt could be like trying to put out a fire with gasoline. It's a delicate balancing act, and one wrong move could send the whole thing toppling faster than a Jenga tower at a toddler's birthday party. But here's where things get really interesting. Remember how we said Japan's economy is the world's third largest? Well, that means its financial sneeze is causing a global economic flu. Let's take a whirlwind tour of the fallout, shall we? First stop, Taiwan. The TAIEX index took a nosedive steeper than a kamikaze pilot, plummeting 5.7%. It's like watching a tech startup's valuation after a failed product launch. Taiwan Semiconductor Manufacturing Co., the heavyweight chip maker, lost 5.3% faster than you can say silicon shortage. Next up, Hong Kong. The Hang Seng Index dropped 2.1%, which in the grand scheme of things might not sound like much, but in the financial world it's like watching your favorite dim sum restaurant run out of dumplings. It's not the end of the world, but it sure puts a damper on your day. And let's not forget about the good old US of A. Remember how we mentioned that Japanese investors are the largest foreign holders of US treasuries? Well, now they might be eyeing those investments like a sushi chef eyes a piece of day-old fish. If they start selling, it could send U.S. Treasury yields on a roller coaster ride that would make even the most hardened Wall Street trader reach for the Dramamine. But wait, there's more! The yen, which had been playing hard to get with the U.S. dollar, suddenly decided to become best friends. It reached a 4-month high, trading at around 151 yen to the dollar. For Japanese exporters, this is about as welcome as a vegetarian at a yakiniku restaurant. Their profits are shrinking faster than a wool sweater in a hot dryer. Now, you might be thinking, surely this is just a temporary blip, right? The market will bounce back, won't it? Well, my friend, in the words of the great philosopher Magic 8-Ball, outlook not so good. You see, this isn't just a case of investors having a collective bad hair day. No, this is more like the financial equivalent of a bad perm. It's going to take some time to grow out. The problem is, when a market as significant as Japan starts to wobble, it sets off a chain reaction that makes the domino effect look like child's play. Investors start getting nervous, and when investors get nervous, they do what any rational person would do. They panic. And panicked investors are about as predictable as a cat in a room full of laser pointers. So, what does all this mean for the average Joe or Jane? Well, if you're planning a trip to Tokyo anytime soon, congratulations! Your yen will stretch further than a piece of mochi at a taffy pulling contest. But if you're counting on your 401k to fund your retirement dreams of sipping Mai Tais on a beach, you might want to hold off on ordering that custom-made hammock. The truth is, we're in uncharted waters here, folks. The BOJ's decision to raise rates is like watching your ultra-conservative grandpa suddenly decide to get a tattoo and join a rock band. It's unexpected, it's a little bit scary, and nobody's quite sure how it's going to turn out. But here's the thing. In the world of finance, uncertainty is the only certainty. It's like trying to predict the weather in London. Just when you think you've got it figured out, it throws you a curveball, or in this case, a typhoon. Because let's face it, folks, what we're witnessing here is nothing short of a financial tempest. But fear not, intrepid viewers, for in the world of finance, as in life, this too shall pass. The question is, what will be left in its wake? Will Japan's economy emerge like a phoenix from the ashes, stronger and more resilient than ever? Or will it be more like a wet cat, bedraggled, irritable, and in desperate need of a warm towel? Only time will tell. But one thing's for sure, this financial roller coaster ride is far from over. In fact, we're probably just cresting the first big hill. So, buckle up, Buttercup, because the twists and turns are just beginning. As we speak, economists around the world are furiously scribbling equations, analysts are burning the midnight oil, and traders are mainlining coffee like it's going out of style. They're all trying to answer the same question. What's next? Will the BOJ's gamble pay off? ushering in a new era of economic stability? Or will it backfire spectacularly, sending Japan's economy into a tailspin that makes the lost decade look like a minor setback? And let's not forget about the rest of the world. As Japan's financial drama unfolds, global markets are watching with bated breath. It's like we're all gathered around the TV, binge-watching the most intense financial thriller ever made. And just when you think you've got it all figured out, bam! Plot twist. So, dear viewers, as we wrap up this episode of Market Mayhem, remember this. In the world of finance, the only constant is change. Today's crisis is tomorrow's opportunity, and yesterday's sure thing is today's cautionary tale. Keep your eyes peeled, your wits sharp, and your financial seatbelts fastened. Because in this global economic roller coaster, the ride's not over until the fat lady sings, or in this case, until the BOJ governor rings the closing bell. Until next time, this is your host, signing off. Stay savvy, stay solvent, and remember, in the game of stocks, you win or you cry. Catch you on the flip side, financial thrill seekers.